Investing in stocks can be an exciting and profitable way to grow your wealth, but it's also a venture that requires careful consideration and research. Before you take the plunge and buy your first stock, it's crucial to have a strong understanding of the stock market, risk management, and strategies that can help maximize your returns. Buying your first stock can feel overwhelming, but with the right knowledge, you can make smarter investment decisions that align with your financial goals. Here are the top 10 things you need to know before you buy your first stock. 1. Understand the basics of stocks and the stock market. Before buying a stock, it's important to understand what a stock is and how the stock market works. A stock represents ownership in a company, and owning stock means you own a piece of that company. The stock market is where buyers and sellers trade shares, with prices fluctuating based on factors like supply and demand, company performance, and broader economic conditions. It's essential to familiarize yourself with terms like bull markets, bear markets, and dividends, as well as how stocks are traded. 2. Assess your risk tolerance. Investing in stocks can be risky, and it's essential to understand your own risk tolerance before diving in. Risk tolerance refers to your ability and willingness to tolerate losses in your investment portfolio. If you're someone who gets anxious when the market fluctuates, you may need to focus on less volatile stocks or start with smaller investments. On the other hand, if you're comfortable with taking risks and can handle the ups and downs of the market, you might consider more aggressive stocks that offer higher potential returns but also come with more risk. 3. Set clear financial goals. Before you buy your first stock, it's important to define why you're investing and what you hope to achieve. Are you investing for retirement, to build wealth, or to generate passive income? Having clear financial goals will guide your investment decisions and help you choose the right stocks for your needs. For example, if you're saving for retirement, you might want to focus on long-term growth and stable companies. If you're looking to generate income, stocks that offer dividends could be a good option. 4. Do your research on companies and sectors. When choosing stocks, research is key. It's important to understand the companies you're investing in, including their financial health, growth potential, and competitive position in the market. Look at factors such as revenue growth, profit margins, debt levels, and management quality. You should also consider the sector in which the company operates. Different sectors, such as technology, healthcare, consumer goods, and financials, tend to perform differently during various market conditions. Diversifying your investments across multiple sectors can help manage risk. 5. Diversification is key. One of the most important principles of investing is diversification. Diversifying your portfolio means spreading your investments across different stocks, industries, and asset classes to reduce risk. Instead of putting all your money into one stock, consider buying shares in different companies or sectors. This way, if one stock performs poorly, the others can help balance out the losses. You can also consider exchange-traded funds, ETFs, or mutual funds, which allow you to invest in a broad range of stocks in a single purchase. 6. Understand the role of dividends. Some stocks pay out dividends, which are regular cash payments made to shareholders from a company's profits. Dividends can be an attractive feature for investors looking for passive income. However, not all stocks pay dividends. Many growth stocks reinvest their profits to fund expansion rather than paying dividends. It's important to decide whether you prefer stocks that pay dividends or those that focus on capital appreciation, which means the stock price increases over time. 7. Don't follow the herd. It's easy to get swept up in the excitement of hot stock tips and trending investments, but following the herd can lead to poor decision-making. Investing based on emotions or fear of missing out, FOMO, can cause you to buy stocks at inflated prices or invest in companies without doing proper research. Instead, focus on your own research, stick to your investment strategy, and avoid making decisions based on market hype. 8. Understand the impact of fees. When buying and selling stocks, there are usually fees involved, such as brokerage commissions, transaction fees, and account management fees. These fees can add up over time and eat into your investment returns. It's essential to be aware of these fees and choose a brokerage platform with low fees and a user-friendly interface. Many online brokers now offer commission-free trades, but it's still important to understand how other costs may affect your returns. 9. Be prepared for market volatility. The stock market is volatile, and prices can fluctuate significantly over short periods. It's important to have a long-term perspective when buying stocks. While market downturns can be unsettling, they are a natural part of investing, and historically, the stock market has always recovered over time. If you're investing for the long haul, don't panic during periods of volatility. Instead, focus on the fundamentals of the companies you've invested in and stay disciplined with your investment strategy. 10. Don't invest money you can't afford to lose. Finally, it's essential to only invest money that you can afford to lose. The stock market can be unpredictable, and even well-researched investments can experience downturns. Never invest emergency funds or money you need for short-term goals. Instead, make sure that your investment money is part of your long-term financial plan and that you're comfortable with the potential risks. Buying your first stock is an exciting milestone on your journey to financial independence. However, it's crucial to enter the stock market with the right mindset and knowledge to maximize your chances of success. By understanding the basics of stocks, doing your research, diversifying your investments, and sticking to your long-term goals, you can make informed decisions that will help you build wealth over time. Remember, investing is a marathon, not a sprint, so be patient and stay focused on your financial objectives.